Hello and welcome to yourfinance.tv. Today we welcome Nick Bohnsack, CEO and President of Strategas Asset Management, to hear his take on the markets. Welcome to the show, Nick.
Scott, it's good to have me. Thank you.
Before we jump into the questions, don't forget to click on that like and subscribe button that's right below. Start with that and all the great shows that we have and great content like we're just about to have. All right, Nick, it's been a while since we've caught up and inflation remains high, like you said in our last discussion. We've seen strong ADP and jobs numbers today. Is it possible for inflation to come back down to that 2% level without a big jump in unemployment numbers?
Yeah, we think it's going to be difficult, Scott. And I think what the chairman of the Federal Reserve has sort of laid out is the Fed's real focus on not repeating the mistakes that they feel they made in fighting inflation back in the 1970s, which is to say, it comes down a tick and then they sort of take their foot off the gas a little bit. And it comes roaring back. So the question by our lights is how high will they take the Fed funds rate? And certainly with 50 basis points back on the table, it seems as though we have a way to go, and the economy will, very likely continue to sort of be operating under tighter financial conditions. I think to your question specifically is if they get it going back in the right direction, which is to say those year-on-year rates of change start to arrest lower again. What is the cost of trying to get inflation back down to 2%? 4% is achievable, and they sort of lean into it a little bit more. 3% is achievable, and how far do they have to lean in to really get it back down to 2%? And is their conviction high enough? And is their conviction high enough to withstand the political pressure and the pain that might inflict on the economy? So the Fed's in a tough spot here. Powell is in a difficult position, but for the time being, it seems as though financial conditions are going to get tighter.
That leads me into the question of Powell's performance yesterday in front of the Congress. It obviously shook up the markets a little bit of a sell-off on the back of it, and now people talking about the 50 bips like you were referring to just there. What did you think of his performance yesterday?
Yeah, Powell sort of got himself into this, mess, all by himself. So I think he's trying to walk back some of what the market perceived to be more dovish comments over the last month. I think it's interesting that the Fed has put out some white papers from some of the regional branches that have suggested using the Taylor rule, the terminal rate might have to be as high as 9%. I think it's interesting that the timing of those papers coming on the heels of Lyle Brainerd leaving the Fed for the White House and sort of the chairman maybe re-exerting total influence, not that he had any particular wane in his influence, but the Fed needs to be a little bit more hawkish here. They got to talk the market down. So our expectations are that they're going to go right for it.
Okay, now personal debt is at a record level, and it still feels like there's a post-COVID spend going on in the US, especially if you look at places like Disneyland. When you look at this debt level, do you find it a concern for the economy in a rising rate environment?
Yeah, I think one of the things that we have a real difficulty in explaining to clients is just why the labor market has remained so resilient. But one of the things that concerns us, you highlight the debt component, to be sure, we'll come back to that in a sec. But one of the things that concerns us is that companies, they generally fire in mass, right? So when the cost pressures get too extreme and the margin degradation too acute, unfortunately, they can lay off a lot more people quicker than they can hire one person at a time. So, that I think, unfortunately, is the other shoe to drop. Now, you mentioned some of the spending data. It's remained strong, but we know that it's coming less and less from the transfer payments we saw during COVID as the health emergency is basically subsided in large part, and more from revolving credit. And of course, the vast majority of Americans don't pay off those bills every month, as you know, and the interest rates on that are rising. So this is a very acute pressure that's, at least in our view, kept us somewhat more suspicious about what we deem to be the counter trend rally in stocks.
Now, this next question it isn't the $1 million question, but it is a big question on everyone's minds. How far do you think the Fed will take these rates?
Well, with 50 basis points back on the table and sort of all the attendant hawkish rhetoric that goes along with it, my suspicion is that they would have at least 100 basis points left of tightening this year. The question is, does that come at 250s, or does it come as a 50 and a 25 and a 25? I'm not expert enough, certainly, to know. This does show that the Fed will live to its word of being data dependent, however. And if the labor market doesn't doesn't take a knee, there may be even more than that. But our sense in talking with policymakers, former policymakers, just clients in general, and our own sort of gut is that the Fed doesn't view a recession as being a policy mistake. They view inflation expectations and the volatility of inflation remaining unanchored as the policy mistake. And at the end of the day, while they probably don't say this quite publicly in the way that you and I can talk about it, a recession would solve a lot of those problems. You have an economy that's not doesn't have supply and demand in equilibrium, and when it contracts, it helps to set them back in equilibrium, and that ultimately will help curb inflation as well. So 100 basis points is our standing answer to your question, but there may be more than that, unfortunately, if the labor market remains so resilient.
All right, and the last question for you, I want to look at housing and throw a crazy stat at you. Over half of US mortgages originated in 2020 or later. In this environment of higher interest rates, what do you think that could mean for the housing market going ahead?
Yeah, that's a great question, actually. So I would look at it in two different ways. I'd say first, we do know that the quality of mortgages is demonstrably better than it was leading up to the financial crisis, particularly on the retail level. So on that score, I don't know that we're setting ourselves up for a terrific amount of pain. What we do know, unfortunately, is it's not equities, it's not the stock market or retirement funds. It's the value of folks' homes that really underpins their propensity to spend. So to the extent to which you start to retard any appreciation in home prices generally and see them move lower en masse, consumers will more than likely stop spending as much money as they have been. So we've been sort of thinking about some decline in home prices. Again, that is atypical for the U.S. economy. We're more conditioned to it because of the financial crisis. But something on the order of 5 or 10% in some of the more frothier regions is probably likely in our future. The other item that I would pay attention to, which are steps away from households, is into the commercial real estate market. The idea of working from home, or the truncated 2, 3, even a 4-day work week keeps people away from urban areas, and some of those commercial deals that looked so good 15 years ago and 10 years ago and 5 years ago are going to start to have some real prepayment and payment issues. You're seeing some of the A players in the space, names already start to default and miss payments. We would think commercial real estate could be a shoe here that may drop.
All very interesting. Thanks so much, Nick. We really appreciate you being on the show, and we look forward to talking to you again soon.
Thanks, Scott. I appreciate it.
For everyone else out there, good luck investing.